Okay, ladies and gentlemen, we got two things to talk about when it comes to Australian housing.
And a huge pullback in apartment construction. Meriton boss Harry Triguboff on the new reality for developers.
Okay, new reality for the developers. That is a good entry into today's update. But I'm going to read you something that's just come out, today. Today's 29th of August 2018. Westpac raises variable mortgage rates. So Westpac will increase. So this is updated 25 minutes ago. I think the decision was made earlier today. It's just before 6 p.m. in Sydney. But yeah, this has just come out, and Westpac will increase its variable mortgage interest rate to counter rising funding costs that are threatening the bank's profit margins. Make no mistake, banks are out there to make profit. Everybody knows that, and fair enough, I suppose they should be in a capitalist system. In what way, that's obviously arguable. I'm sure I'm going to get more comments, but banks are necessary, maybe not in a form that we have them now. So continuing on with this article, it is the first of the four big banks to raise interest rates for all its variable home loans this year, although many smaller banks had already moved to offset higher costs. The bank said all variable mortgage rates will rise by 14 basis points, so that's 0.14 percentage points from September 19th. The increase will apply to new and existing customers and affects both owner-occupiers and investors. So Westpac's new standard variable rate will vary considerably from 5.38% for owner-occupier with principal and interest loans up to 6.44% for property investors with interest-only loans. So this tells us that interest-only loans attract much bigger interest. The chief executive of Westpac's consumer banking division, George Frazis, encouraged investor-only customers to consider shifting to the lower rate principal and interest loans. Importantly, customers wanting to switch from a variable interest-only loan to a lower rate principal and interest loan can do so without any penalty or fee, he noted in the statement. The banking regulator placed a 30% cap on interest-only lending as a share of all new home loans, while also encouraging banks to rein in investor lending, leading to the big difference in the rates between the products as banks encourage customers to switch. So now this is an important one. Westpac is Australia's biggest mortgage lender to property investors and has a higher share of interest-only loans. So this makes it even more important that Westpac is the first of the four big banks that has raised the interest rate outside of the cycle. So the Reserve Bank of Australia has not increased the interest rates. I think the current official cash rate is 1.5%, I believe. So they're the first ones out of the block. They've blinked. It is no secret that other three banks are going to have to do the same, because again their cost of lending has gone up and they have to cover their costs. It's as simple as that. And before we go on to the second segment of tonight's presentation, where the apartments seem to be tanking, we'll get to that. Just let me read you that the Mr. Frazis of Westpac is also said this is a tough decision, but we have a responsibility to price our mortgage products in a way that reflects the reality of our funding costs, he noted in the statement. And wholesale funding is an important component in our mortgage pricing. In particular, the bank bill swap rate, which is a key wholesale funding rate for mortgages, increased by about 25 basis points between February and March this year and has remained elevated. We initially hoped that this increase would be temporary, and therefore we have incurred these costs over the last 6 months. The rate changes announced today will not recover these costs. So they're bleeding. They had to pass on the cost of lending. So next story. Okay, this next segment is kind of a big deal, and you'll see why.
It wasn't that long ago the skies in some of our biggest cities were full of cranes building an endless array of high-rise apartment blocks. But as Australia posts yet another record month of unit construction slowdown, there's no denying the housing boom is on the slide. And that's forcing property developers to reassess their projects. Here's Rachel Papazzoni. These are the twin towers of Aura. It's one of the 4 phases of the master plan community named The Retreat, being built in Sydney's Olympic Park. The ambitious 1,000 plus apartment project is one of property mogul Harry Triguboff's latest developments under his Meriton brand.
I mean, you knew I was going to stop here, but I mean, 1,000 apartments in those twin towers in the whole development in Homebush, which is Olympic Park, which is where the Olympic Games were held back in 2000. It is not the furthest away from the city, but it's not the closest either. It's definitely something called Inner West, and it is definitely a suburb of Sydney.
It's a brand that's left a 75,000 apartment-sized footprint throughout Sydney, Brisbane and the Gold Coast during Meriton's 50-year history. But after years of rapid growth, the apartment construction market is heading south. There's a trend that we're seeing, that there's been a slowdown in apartment construction. Is Meriton experiencing that?
I'm experiencing more than anyone. I build the most.
At the peak of the apartment construction boom 2 years ago, 70,000 high-density apartments were built around Australia in a 12-month period. But a leading economic forecaster says those days are over.
In the last financial year, we estimate that it was probably closer to about 50 to 60,000. And in 2 years' time, we think it'll probably fall to 30,000.
Even one of Australia's biggest residential developers isn't immune to the changes.
Now, you've got to understand one thing. I actually thought about this, as I think about many things in life, is that the developers know how to develop. Now, they can't just simply say that they know that the cycle is turning, but they have to be cautious, but they have to continue to run their business. So developers know how to build houses, to develop. They're not going to turn around and say, we think there's a cooling coming, until they actually feel it and they run out of capital. But you'll see it in this report where they're unable to actually sell off the plan apartments so they can raise capital that way, because it's harder for them to raise capital from the banks. But I digress. So going back to the fact that builders will always build, they'll build and build and build, and in the last 20-30 years they've made money on most of the developments, and when the cycle completely turns and one of their projects will probably turn south, and they will lose money on it, but the company structures will probably take the blow, and they'll be okay. So after 20-30 years making money, it will be that probably last project where they're going to lose money and they'll have to stop. But they're not going to stop until they have to stop, so they're just going to continue to build.
So what I do, I sell some of my old blocks, so then I give more variety for the purchaser, and I also will be leasing more. Now, when the market will improve, then I will take some of these units from leasing and sell them.
While no Meriton projects have been cancelled, there's a clear halt to operations.
We are not buying land at the moment. We bought the last land about 2-3 months ago, but we'll be back soon.
Yeah, so what we've seen, and CBRE obviously acknowledged it.
Global real estate firm CBRE is selling apartments off the plan for 300 developments around Australia. It says the problem is widespread.
Yeah, there's been a lot of adjustments. Developers are stalling projects, their next stages aren't coming on, and smart developers, seasoned developers, are really looking at their offering and what purchasers want.
Developers need to secure a significant number of pre-sales to fund their projects, and tighter lending conditions for investors, like bigger deposit requirements, mean they're struggling to lock in those contracts.
Developers, due to the banking regulations, rely on pre-sales to be able to finance their projects. And being the largest company of pre-selling apartments, we're finding unless you have exceptional attributes, it is very difficult to get those pre-sales of hundreds of apartments that are required to the developments.
While economic forecasters tip a halving in construction by 2020, the hard numbers are already proving the slowdown. The Australian Industry Group's July Performance of Construction Index was the slowest month for new orders in more than 2 years, and it was also the sharpest monthly decline for apartment construction work in 5 years. Property advisory firm Charter Keck Kramer agrees we're in the midst of a significant pullback.
In the midst of a significant pullback.
Certainly across the major capital cities, seeing in terms of completions a potential slowdown beyond 2018, 2019. It's difficult to forecast too far beyond that.
But those in the industry say there is a silver lining. Our population continues to grow,
The population continues to grow. I don't know where these people are going to come from to be able to pay, $1 million for these new apartments. I mean, you can bring people in, but they're still going to have money, and I don't think they have that kind of money.
25 million this month, which means demand for apartments like these isn't going away.
There'll be a need to build housing. We estimate over the next 5 years we're going to be needing to build about 196,000 dwellings per annum just to keep up with population growth.
But for buyers, now's the time to grab a bargain. Harry Triggerboff will even pick up your stamp duty bill.
Because the market's weak. But I won't do it forever, I promise you. That'll be the first thing I'll pull out.
Right. Okay. So the market's weak, but it's a good time to buy. I think I mentioned it in one of my other videos. I don't think it's a good time to buy. You do not buy in a declining market. You don't catch a falling knife. I can use as many analogies as you'd like me to, but the conclusion is one, and it's the same one. And in my opinion, don't go nowhere near it. Rent, hold on to what you have. If you've got more than 1 or 2 or 3, sell some while you can. Cash in the profit of these great couple of decades. With that, take care everybody, and we'll talk to you next one.